Hi, in today's video we discuss mean reversion trading. The concept of mean reversion relates to the belief that asset prices tend to return to their long-term mean or average. In trading, this suggests that a trader can profit by initiating trades when asset prices are at extremes and later exit when the prices approach mean. Conversely, one can also enter the mean and exit at extremes, depending on your preferred approach. A simple example of this could be trading a trend line. Let's say a stock's price is trending upwards and taking support at an inclined trend line. One can buy when the price approaches the trend line and sell when the price moves too far away from the trend line. While trend lines can be simple to trade, trading means reversion is a much more nuanced way of trading the markets, one that requires a lot of observation and practice to master. Let's understand where to begin when you're trading mean reversions in stocks. The easiest way to trade mean reversions is to trade range-bound prices. If prices gyrate between two extremes for a prolonged period, mean reversion could be a solid money-making strategy. However, there are only a few stocks that spend most of their time moving between two price levels. Most of the time, such ranges have a limited life and stocks either break out or break down. Therefore, it can be difficult to trade mean reversion in range-bound prices on a sustainable basis. Trading means reversion means you're looking for turning points in the price. You're looking for junctions where the price move is at an extreme, is getting exhausted and may be ripe for a reversal to the mean or away from the mean. Essentially, the starting point for trading such a strategy is to first define the mean. Defining the mean is also the most subjective part of the strategy because the mean is different for different traders. For some, it's a moving average, and for some, it's the two extremes of an oscillating indicator, and for some, it's the trend line. Traders choose different trading mechanisms to trade different mean reversions, not forgetting the various time frames. Some may want to use a 2-minute chart, whilst others may want to use a weekly chart. Let's start with trading mean reversions using a moving average on a weekly chart. When trading mean reversions using a moving average, traders look for price moving to either extreme of a moving average. In the simplest form, they buy when the price goes below a certain extreme and sell when it reaches a certain extreme above the moving average. There are, however, some technicalities that the trader should consider while trading these mean reversions. Price reacts differently when it is trending compared to when it is consolidating. In an uptrend, prices will travel more distance above the moving average and will often take support at the moving average. The opposite will happen in a downtrend. The moving average will itself be upwards or downward sloping when the price is trending. When the price is range-bound, the moving average will be flat and the price fluctuates to both extremes. The key while trading mean reversions using the moving averages is to understand the trend and trade the reversion accordingly. The trend is the force and the bigger picture that one must always keep in mind while trading mean reversions. One easy yet effective way to determine the trend is using Dow theory, a topic that we have covered in detail in one of our earlier videos. For example, in this weekly chart of the S&P 500, the index has been in an uptrend for much longer periods than it has been in a downtrend. That's the characteristic of all broad market indices, as they consistently shed losers and include new winners that eventually take the index higher. When the index was in an uptrend, that is, when it was making higher highs and higher lows, the price seldom stayed below the 10-week moving average and spent a considerable time above the line. However, it did revert several times to the moving average, which was the mean in this case. A smart trader could have traded the situation by going long as price approached the moving average, whilst exiting when prices move significantly away. The opposite could have been profitable during downtrends. Let's now look at a widely used and effective indicator for mean reversion trading, Bollinger Bands. This indicator is an adaptation of the moving average. It's made of a 20-period simple moving average in the middle and two standard deviations of the price of the asset at both ends. It gives a band that makes it easy to identify and trade extremes in the price. The price hardly stays above and below the extremes of the band, and therefore this range is a good starting point for trades. The indicators can be more effective and accurate when combined with another indicator, one of my favorites, the MACD. Let's understand this with the same example of the S&P 500 index. The S&P 500 chart is plotted with both indicators. As we can see, when the price was in an uptrend, it stayed quite close to the upper end of the Bollinger Band range. However, the price reaching the upper extreme was not a good enough signal by itself to initiate a short trade. The price continued to stay elevated even after the indicator flashed overbought conditions. However, when we look at this indicator along with the MACD, it gives better clues on the strength of the trend and therefore helps to identify the turning points of the trend. Here, when the price was in the uptrend, though it was hitting new highs and stayed near the upper end of the Bollinger range, the MACD was shouting weakness as it stopped hitting newer highs. Due to this weakness in the MACD, the Bollinger Band signal became much clearer. In the same chart, when the index was bottoming out, it was hitting new lows and was staying near the lower end of the Bollinger range. However, the MACD indicator was not hitting new lows and bottomed before the price. Here too, the Bollinger Band signal of price extreme when combined with MACD could have given a good reversal trade. Another category of a mean reversion trade is pairs trading, in which traders take a pair of stocks correlated positively or negatively and see if the correlations have become disturbed due to the market extremes. For example, if two companies are in the same industry and one gets a higher valuation multiple than the other, the trader could short the stock that commands the higher valuation and buy the stock that commands a lower valuation, betting that the valuations of both the stocks will revert to mean. Traders also use algorithms to find pair trades and to execute them. In fact, one of the top hedge fund performers of the last 2 decades, the Medallion Fund, traded these anomalies using mathematics and algorithms and achieved very high double-digit returns. Trading pairs for mean reversion is quite a complex exercise and isn't advisable until you gain significant expertise in the markets and know how the correlations work between stocks and industries. In mean reversion trading, it's always essential to double or even triple check your entry points because you're betting on the reversal of the trend, and trends can often last for long periods, which lowers the probability of success. When you enter at the right point with a low-risk exit in place, you can trade the mean reversals much more confidently. Regular viewers will know that I use a form of mean reversion, but only for well-diversified funds, whereas I use breakout trading for trend continuations for all of my singular stock positions. Anyone interested in my strategy can of course join our group, providing access to my PDF and our bespoke breakout scanner, both of which I use in the US Investing Championships. Irrespective of the strategy you choose, you must always have a risk management plan in force. The risk of ruin is much higher in mean reversion trading for single stocks. Therefore, your first priority must be to build a skill of preserving your capital. Everything else will gradually fall into place. Thanks for watching.